Coming up today, is it over for Nvidia as Jensen Huang unloads shares? Is Bitcoin sending us a warning? Nasdaq, the most overbought since 2018. Is now a good time to get into small caps? Jobless claims come in high, housing comes in weak, and oil continues climbing higher. Welcome back everybody to the Click Capital Daily Market Review. My name's Jared. I'm going to get you all up to date on everything important happening across financial markets. If you haven't already, smash that subscribe button and these videos will show up in your feed every day. And if you're interested in stocks and trading, then you're going to know everything that's going on after tuning in to the Daily Market Review. And it appears the market could be stalling out a little bit here as we are technically overbought in the short term. Bit more so today on the Nasdaq, looking at volume breadth. And once again, stocks making new lows, drifting higher, outpacing stocks making new highs. A little bit of a bump up for the VIX there today, 13.2, along with volatility risk premium. Skew index climbing again. Bond yields quite subdued. High yield bonds still holding ground. The dollar still showing strength. Bitcoin still a little soft here. And crude continuing to climb higher. I'll come back to all of that a bit later on. First, just looking at the biggest stocks out there. Apple peeling back a bit here today after some wild price action we've been getting the last few weeks. And of course, the big fella Nvidia putting in a big bearish engulfing candle on volume. Something we can see when the market at least likes to take a breath and maybe consolidate a little bit. We saw that same pattern back on the 8th of March. Stock price has consolidated for a few months, bit of a shallow pullback. Going back a bit further, prior to when this rally kicked off early last year, going back into 2022, it was already in a downtrend here when we got some reversal signals, but when it peaked out in 2021, kind of a similar look and bearish candles. We had that strong hard run up, then it kind of comes to a halt and you can see the selling pressure just come in. Then of course she rolled over. So what is it now for Nvidia? Is this the top, the final top? Now that it made the world's largest company, overtaking Microsoft in a similar pattern to Cisco back in early 2000 that everybody can see? Or is it just a sign of short-term exhaustion and just some profit taking, come back, tag the 50-day, and then off we go again? Well, we did just get a worrying sign from the man that started it all, President CEO of Nvidia, Jensen Huang, offloading a fair amount of shares this past week. 480,000 to be correct. Prior to that, he hadn't sold any shares since September last year. He had been riding this rally pretty well. However, he's just offloaded about $62 million worth of shares. Still owns a boatload, 867 million shares to be accurate now. However, overall, that's not really a bullish sign, maybe contributing to a bit of a consolidation we're seeing in the stock already. And it's not just Jensen, it's also his mates on the board as well. We've seen a sharp spike so far this year in Nvidia insider sales, now approaching the $800 million mark. And we're seeing a few traders follow suit, starting to bet against the stock, and judging from myself across social media, there is way more people calling for a top than calling for it to keep going. Not saying the consensus is wrong. However, it is something to note when everyone's calling for the same thing. And this comes just in front of a big triple witching tomorrow. Third Friday of the month, when we always get regular monthly options expiry. However, it's the third month of the second quarter. In addition to stock options, we also got index futures and index future options also expiring, and we've seen huge volumes in options lately, setting up for a big Friday afternoon tomorrow, which sometimes can get a little spicy. And even though we've got growing put option volumes for the here and now, still dominated by calls. In Nvidia, 3.7 billion notional call option today. Pretty sizable amount for puts though, a bit over 1 billion, and pretty busy day in the options market overall for a Thursday. 54.1 million contracts traded, 56% of them calls. However, looking at overall stats, we've now got the put to call ratio on Nvidia at break even. In fact, slightly more puts open than calls. And it's easy to see why people are betting against Nvidia. Currently 31% above the 50-day VWAP, super stretched here. Stock price has already more than doubled since the start of the year. And of course, that really persistent weak market breadth that everybody is talking about. Even though overall volatility is still really low here, around 13 on the VIX, typically a sign of more bullishness to come. Generally the market gives way and pulls back sharply when the VIX is already above at least 16 or 18, but we are getting some mixed signals out there. This skinny bull rally doesn't have that huge risk-on bullish breadth and sentiment across the board. Otherwise, we'd be seeing Bitcoin ripping up to all-time highs. Some saying it's sending us a warning that the stock market's about to sell off as the correlation with the Nasdaq has broken down. However, I'm not sure about the argument of the Nasdaq following Bitcoin. I think there's a stronger argument to be made for vice versa. And what's also interesting, we've seen huge inflows into these new Bitcoin ETFs these last couple of months. However, that hasn't translated into all-time highs, and that could potentially be because we've got long-term whale, large Bitcoin holders, in which less than 1,000 Bitcoin wallets own almost half of all outstanding Bitcoin. Supposed to be the currency of the future, just not for everybody. They've actually been taking advantage of these high prices, seen a sharp spike in those old wallets that have been hodling, cashing in, turning their crypto into fiat. Last time we saw that sharp spike, back in early 2022, Bitcoin rolled over significantly in the following 6 months. I think it would catch a lot of people by surprise if Bitcoin rolled over hard from here, as again, most people are leaning to one side of the ship here. So like everything, there's two ways to look at it. Tech stocks, strong fundamentals, the AI boom, but then what about valuation? How are we supposed to balance all of that? Well, I'd agree with this article headline. Tech stocks are too pricey to buy, they're too hot to sell. Kind of in that really tough middle spot. Definitely wouldn't want to short them here. At the same time, they're not exactly cheap. I think the best way to play it is with a simple trailing stop. Let the market tell you when to get out. There's a look at the top 10 largest companies in the world, with 8 of them in America. The only ones outside America: Saudi Aramco, largest oil company in the world, out of Saudi Arabia, and Taiwan Semiconductor, out of Taiwan. 6 of the top 10 largest companies. Tech, there's Nvidia slightly out in front. Also notable is Berkshire Hathaway. And I was just reading a stat the other day. If Warren Buffett hadn't given away any of his shares to charity, he'd actually be the richest man in the world right now. Net worth close to $300 billion. Overtaking Elon Musk. However, as they say, you can't take it with you, so he's done the right thing and given it away to people that need it a lot more than him. And another interesting piece of data I wanted to share with you today. The top 30 largest stocks from the S&P 500 25 years ago, back in June 1999. You're welcome to pause your video player to take a closer look at this. But interesting, looking at the top 5 back then: Microsoft, General Electric, Exxon, Walmart, and Cisco. Fast forward to this month, and these stats are about a week old because we can see Nvidia still number 3 there. Other than that, it's pretty much all the same. Top 30 largest stocks right now. And just to save you from counting, only a third of the 30 largest stocks today were also in the top 30 back then in 1999. Just shows you the rotation that even happens at the top of the stock market. Most big companies at the top don't really stay there over the long term, even though it's hard to imagine that they couldn't. So we know by long-term measures, tech is big, dominating the stock market. Valuations climbing back to 1999 levels. But even for the here and now, the Nasdaq index is the most overbought since 2018. Just looking at the RSI, now above 80. And it's no wonder shorts and short-only hedge funds and even long-short hedge funds struggled last 15 years, especially the last couple of years. Ultra-loose monetary and fiscal policy. Most of them have given up, shut up shop, moved on. We can see that. An absolute nosedive in short interest on the SPY and Qs. This can persist for some time. However, it's most likely setting up for an epic bust, crash, rollover that is most likely going to occur at some point over the next 2 years, in my opinion. We're also hitting some extremes on market breadth. Percentage of S&P 500 stocks outperforming the index over the past 30 days. The lowest, and by a long way, over the last decade. Only 17% of stocks outperforming the index, where we typically average around 49%. And just to look at what sectors are having that weak breadth, by the amount of days since they've seen a 52-week high: REITs, 173 days. Consumer discretionary, 89. Healthcare, 82. Obviously doing the best. Technology, communication services, that's where it's really powering the S&P 500. Also looking at the annual percentage change between the S&P 500 equal weighted index and the S&P 500 market cap index that we all look at. If we finish where we are now, below 10% price underperformance of the equal weight index, that'll be the first time in 35 years it's done 2 consecutive years below minus 10%. And just looking back over the last 10 years, you can see that huge underperformance of most of the market versus the S&P. We saw a similar thing in the second half of the 90s, but that did precede a good decade of outperformance from the rest of the market. Markets are often symmetrical, swing from lows to highs, and so on. And there could be good reason for the rest of the market to come back, looking at valuations. Because right now, the PE ratio and forward PE ratio in the S&P 500 is significantly skewed to the upside, thanks to the top 10 stocks. As a group, they have a PE of 30, which is 147% greater than average, lifting the S&P's PE to 21. However, looking at the bottom 490 stocks, they got a really reasonable PE of 17, which is only 12% above the long-term average. And once again, a huge gap in valuation, the top and the bottom, similar to what we saw in the late 90s. Not just a huge current valuation gap, but also a narrowing of earnings growth between the Magnificent Seven and the rest of the S&P 500. We can see those big tech stocks absolutely ripping in earnings from the 2022 lows, thanks to the boom in AI. However, that's bound to plateau out, and the forecast is for the rest of the market to start showing some earnings growth and close that gap going into next year. Not just the rest of the S&P 500, but also small caps. Profits are expected to continue to recover. Looking at quarterly, year-over-year bottom-up EPS growth trajectories. Small caps in the dark blue there. Here we are in Q2 2024. You can see that going all the way into Q4 next year. Starting in the third quarter of this year, small caps expected to outgrow large caps in earnings. And contrary to popular belief, small caps tend to outperform large caps during secular bear markets. We can see that in over 100 years of data. Up the top here, you got the S&P 500 index. In the red boxes are secular bear markets. Overall markets gone sideways, consolidated for many, many years. Down the bottom here is the ratio of small caps versus large caps. And you can see in those periods of secular bear markets, small caps outperformed large caps in all three major instances. And I expect next time to be no different, because small caps, they're more leveraged to the economy. They're more sensitive to interest rates. They've got more debt. They'll benefit more from cutting rates, which we see in bear markets. And especially given starting valuations, I think the next 10 years, we're most likely going to see a huge outperformance from small caps, value stocks, commodities, and everything else that's been largely given up on these last 15 years. But for the here and now, still election year, really strong seasonality. We've been hit bullish technical seasonals left, right, and center all year. Market's even gotten a bit ahead of itself. Typically finish an election year up 12%. We're already pushing 15% here. Normally mid-year of election year, it's pretty bullish seasonality. However, you'll find if the market gets too ahead of itself, can create for a bit of a softness and consolidation. And just looking at some other seasonality, the first 10 days and last 10 trading days of each month. On average, each month has about 20-21 trading days. Second half of June, quite often flat. However, the first 10 trading days of July, the most bullish 10 trading days of the entire year. S&P on average add on 1.5%, finishing higher 69% of the time. And let's not forget, there's record high liquidity to support equity and credit markets. We can see that with bank reserves and money market mutual fund assets. M2 money supply. There's a lot of cash sloshing around out there, and it always has to find a home somewhere. But that's Wall Street and markets. Looking at the actual economy, we're seeing further signs of softening jobs market. Weekly jobless claims coming in higher than expected. Not by much, but we're still seeing some upticks. Same deal on the housing market. Building permits and new housing starts coming in weaker than expected. And I'm sure a few of you will notice in America, Canada, Australia, other developed nations, there's growing inventory of houses for sale, with a lot of sellers having to accept a lower price than what they had hoped for. And we now have a lot of fresh buyers over the last couple of years with mortgages already exceeding their equity. And we do have a bit of softness around the world. We just saw Switzerland come out with a second rate cut just after they did their first one a few months back. However, the Bank of England chose to hold rates today, but did say it was getting closer to cutting rates. They're on the verge. Like I think the Fed and J-Powell is, they just need to see a couple more good prints, and I think they can cut in September as well. And so is it really going to be different this time? Looking at the actual New York Fed's probability of a recession in the next year, based off the yield curve, we're currently sitting above 50%. The only other time it's been higher than that was back in the early 80s, which we had a very decent sized recession. In fact, it only has to be above 30%, and it's almost bang on every time with forecasting a recession. So if we don't get a recession in the next year or so, it will prove the yield curve to be wrong like never before. And many people in finance, myself included, consider this one of the most important and accurate financial indicators there are. But what's definitely keeping a recession at bay for now is a record amount of federal government spending. Spending like it's going out of fashion. That's been the case ever since mid-2020. And so even though we have a soft consumer, still largely drowning in inflation, businesses are still spending well, AI boom, but it's really hard for an economy to go in a recession when you've got the government spending like record. Just money flowing left, right, center. It's most likely going to continue up until the election. However, all that spending hasn't exactly translated into greater prosperity for most people. Definitely for Wall Street, definitely for politicians and their lobbyist friends. And we've seen that with the $42.5 billion rural high-speed internet plan. After 3 years, not even a single home is connected. Not only that, the $7.5 billion investment for electric vehicle charging stations has only produced 7. Maybe the federal government should have handed their internet and EV contracts to Elon Musk, who could have done that for 1/10 of the cost and 10 times faster, like he's been proven to do. And that big blowout in the federal budget deficit, the more than $2 trillion the government's going to spend this year, than what they made in TAC. Over a quarter of that due to student loan relief, in which they're transferring a huge amount of debt from one group of taxpayers to another in a bid to gather votes. And so this administration has been after Elon Musk ever since he released the Twitter files, showing proof that they work in tandem with large tech platforms to censor speech and other things they don't agree with. We even heard Joe Biden say a couple of days ago the future of electric vehicles will be made in America by union workers. But like Greg 16676935420 correctly points out, I'm pretty sure Elon Musk already makes them in America. in which he successfully ratioed the president by more than threefold in the amount of likes he got. And again, just looking at the stats, Tesla actually sold 386,000 EVs in the first quarter this year. Coming in second was Ford at 20,000, GM at 16,000, and in fact, the Tesla Model Y is the #1 most American-made vehicle again for 2024. It's the world's best-selling vehicle, and it's the #1 vehicle in the world by revenue generated. However, you won't ever hear Joe Biden congratulate or even talk about Tesla. It's almost like they don't even exist to them, even though it's one of the greatest American-made products and companies and stories of our lifetimes. And like the late great economist Milton Friedman once famously said, if you put the federal government in charge of the Sahara Desert, in 5 years there'd be a shortage of sand. And he was a great economist, won a Nobel Prize, was a big proponent for free market capitalism, less government intervention, largely blaming monetary policy for inflation, spoke more about how companies should handle the responsibilities of society instead of being bogged down in government bureaucracy. And it's true, the government doesn't have any competition, there's no incentive for profit, there's no getting fired, taken out by shareholders if they mess up. It's just about appearing to do the right thing, sounding right, kicking the can down the road, all that stuff. And actually, Milton Friedman had the great idea of negative income tax, in which low income earners actually get a rebate on their tax return, and you kind of flatten out the extremes of capitalism without going full on socialism. Just looking at a base pay here in the dotted black line, negative income tax is a good way to distribute some of the excess wealth in the system. However, that's unlikely to happen anytime soon, because those that make the rules would stand to suffer slightly, and in fact the trend and the path we're on is the top 1%, people like Jay Powell, Janet Yellen, who's taken over $7 million from doing so-called talks for investment banks. They're on the path to owning the majority of assets, while the bottom half, adjusted for inflation, their income and wealth as a portion of society's wealth, has been steadily downtrending ever since the US was taken off the gold standard in 1971, and really exacerbated after the Federal Reserve's massive quantitative easing, printing money, hugely inflating asset prices for the benefit of those that mostly own them. Anyway, that's the way it is. Unlikely to change anytime soon. Similar story in many other countries around the world, unless we get a real change of leadership, and maybe it'll take the masses to stand up and change things. But for the here and now, the party rolls on for those at the top. Just moving on to commodities, we've got oil climbing back higher with a bit of a pullback in crude and gas supply. After we had been seeing some weekly gains, supply had been flush, and we still have bubbling geopolitics in the background as well, with Ukraine armed with fresh US weapons conducting drone strikes directly on Russian oil infrastructure. Things heating up between Israel and Hezbollah as that war still rages on as well. And even though we've got a rising dollar, we've got gold and silver climbing in the face of that, as normally the two are negatively correlated. However, like I've been saying, foreign central banks are still going to keep adding gold. They will buy the dip, and they're continuing to sell out of the US Treasury as that long-term de-dollarization trend accelerates. And there's a look at the economic calendar today. Swiss Central Bank cutting rates to 1.25, Bank of England keeping them on hold, jobless claims coming in a bit hotter than expected, housing starts weaker, and building permits weaker than expected as well. Looking out to tomorrow, we've got PMIs coming out across the Eurozone as well as America. And don't forget tomorrow's triple witching OPEX. Going to be a lot of option volume, and that could translate into a big move in the market. Fed Fund futures, still pretty much the same. 2/3 chance they're going to cut in September, about another 2/3 chance they're going to cut again in December. Fear and greed index, still in the fear zone, thanks to a really weak market breadth. And corporate insiders, not just in Nvidia, but across the market, doing a little bit more selling here than they are buying. And just looking at the bird's eye view of market trends, still got a weak Russell 2000. 2-year yields and volatility, still downtrending. Bit of a pullback up the front there in semis. Bitcoin still weak, and inflation expectations still underneath the 50-day VWAP as well. Almost into overbought territory on my S&P 500 oscillator. This looks at a number of things underneath the hood. Market internals, options data, volatility, term structures, things like that. And like I said, it can go overbought, and if it doesn't pull back straight away, that can lead to a bit of firming, a bit more strength in the market. However, the market is looking a little stretched here. 5th consecutive reversal signal of mine. That's the most it can give off. And if we don't get a sharp pullback tomorrow or Monday, I'd say we're just going to consolidate and drift higher, let the 50-day VWAP catch up to price, and overall this market looks well supported. But the big one we'll be watching tomorrow is Nvidia, selling off a little bit post-market as I speak. We'll see whether we can get some follow through, take out some weekly lows. However, like I've showed you guys many times before, often when we get these big bearish engulfing candles, we can consolidate, pull back for a little bit, but it can lead to a period of consolidation, even a bit of a pullback, as it is a strong sign of sellers overwhelming buyers and profit taking, which is to be expected after a huge run like this. But everyone's calling for that to roll over the market because of the really obvious weak market breadth. I think it might be a case of the opposite. Nvidia mega cap tech could roll over. The rest of the market, small caps, value stocks, dividend stocks, everything that's been hit hard this last month might actually consolidate or even come back and regain some lost ground. And there's a look at the spread between the Russell and the S&P. Really technically oversold here in the short term, and like I showed you earlier in this video, in the long term as well, technically and fundamentally. That's all I got for you today. Thanks very much for tuning in and supporting this channel. You're welcome to drop your comment below this video with your thoughts, and tomorrow could be a big one, so I look forward to making you another video tomorrow night. Cheers.